An additional way to value your ending inventory is by using the lower of cost or market rule. It's really simple to apply. This rule just says that if the value of the inventory declines while it is being held, the loss should be recognized in the period of the decline. When we talk about cost, we're talking about the dollar amount calculated using one of the four costing methods. So the cost of your ending inventory using FIFO, or the cost of your ending inventory using weighted average, whichever costing method you are using. Market simply means the cost to replace the inventory. So let's look at an example. Okay, you purchased inventory at $8 per unit, and at the end of the year you look to see what it costs to replace that same item of inventory. So the market value, or the cost to replace, was $7. So while you were holding this inventory, it actually declined in value. So you are going to write down or value your inventory at the lower of the two prices. So you will value each item at $7 instead of $8. So all we're doing is choosing the lower of the cost or the market. Sometimes it might be necessary to estimate your ending inventory. There are two methods used to do that: the gross profit method and the retail inventory method. First, we'll look at the gross profit method. A business uses its normal gross profit to estimate the cost of goods sold and ending inventory. The first step is to calculate the cost of goods available for sale. So you'll be given your inventory, net purchases, net sales, and the normal gross profit percentage for the company. So to calculate your goods available for sale, we remember our cost of goods sold formula is beginning inventory plus net purchases. So both of those numbers are given, so it's really easy to complete step one. Calculate the cost of goods available for sale. Step two is we're going to estimate the cost of goods sold by deducting the normal gross profit from the net sales. So here are our net sales, $110,000, and here's our gross profit percentage. So what we know is that 40% of the sales is gross profit. The other 60% is the cost. So in step two, we're going to take our net sales, subtract out the gross profit, which is $110,000 times the 40% to get $44,000. So that leaves our cost of goods sold as being $66,000. In step three, we're going to deduct the cost of goods sold from the cost of goods available for sale. So remember, our cost of goods available for sale is $150,000. So we either sold them or we still have them in ending inventory. So if we sold $66,000 of goods, then we must still have $84,000. So that's our ending inventory. Okay, now let's look at the retail method. This requires a business to record both the cost and the retail prices of all goods purchased. So let's look at the 5 steps we need to calculate our ending inventory. First, we're going to compute the cost of goods sold available for sale at cost and retail. So just like the other problem, goods available for sale are beginning inventory plus net purchases. So we have our goods available for sale at cost and at retail. In the next step, we're going to compute the ending inventory at retail by subtracting the sales at retail from goods available for sale. Okay, so here are our goods available for sale. So we know that our net sales for the period is $180,000. This is the same as our cost of goods sold at retail. So if we take the goods available for sale at retail and subtract our cost of goods sold at retail, we're going to get our ending inventory at retail. Okay, in step 3, we want to compute the cost to retail ratio by dividing the cost of goods available for sale by the retail value of the goods available for sale. So in other words, we're going to take the $186,000 here and divide it by $248,000, which is the goods available for sale at retail. So we know that our cost is 75% of our retail. So then we can figure that our ending inventory at cost must be 75% of our ending inventory at retail. So we just take the $68,000, multiply it by our 75% ratio, and so we have figured out that our ending inventory at cost is $51,000. So now we can figure out what our cost of goods sold is. If we take our goods available for sale at cost, back out the ending inventory at cost, then we're going to get our estimated cost of goods sold.